There's a phase in most financial lives that feels stable, controlled, and even responsible, yet quietly limits long-term growth. And this phase is what can be called the safe zone, a space where income covers expenses, savings exist but are rarely touched, and risk is carefully avoided, creating a sense of comfort that feels like progress even when nothing is truly advancing. And in this environment, decisions begin to prioritize preservation over expansion, which subtly changes how money behaves over time. Imagine someone earning enough to pay their bills, maintain a routine, and set aside a small portion each month. Their financial life appears balanced. There are no urgent pressures, no visible crises, and no need to make difficult trade-offs. But beneath this calm surface, a hidden pattern forms, because stability without growth introduces a kind of stagnation that is difficult to notice in the short term, yet becomes significant over longer periods, especially when external systems, such as inflation and asset appreciation, continue moving forward regardless of individual caution. The safe zone is not defined by how much money someone has, but by how they relate to it, particularly in how they respond to uncertainty. Because once basic needs are met, the next stage of financial progress typically requires decisions that involve some level of discomfort, such as investing, reallocating resources, or delaying certain forms of consumption. Yet many individuals remain within the boundaries of what feels predictable, choosing consistency over variability, even when that consistency gradually erodes their purchasing power. From a psychological perspective, this behavior is deeply rooted in loss aversion, a concept within behavioral economics where the fear of losing money is stronger than the desire to gain more. And this imbalance leads to conservative decision-making patterns that favor holding on to cash or low-risk options, even when those options fail to keep pace with economic change. And over time, this creates a widening gap between those who accept calculated uncertainty and those who remain within controlled environments. The math behind this is subtle but persistent, because money that is not actively growing is effectively shrinking in real terms, even if the nominal value appears unchanged. And when inflation averages a few percent annually, the purchasing power of idle money declines steadily, which means that maintaining the same financial behavior year after year results in a gradual loss of capability, even if the numbers in a bank account appear stable. And this is where the safe zone begins to reveal its hidden cost. At the same time, assets such as equities, real estate, and businesses operate under a different set of dynamics, where value tends to compound over time, not in a straight line, but through cycles of growth and correction, and participation in these systems requires a willingness to tolerate short-term fluctuations in exchange for long-term expansion, which stands in contrast to the safe zone mindset that prioritizes immediate stability above all else, creating a divergence between two financial trajectories that may start similarly but evolve very differently. Historically, this pattern has repeated across different economies and time periods, where individuals who remained overly concentrated in stable but non-growing forms of money found themselves gradually losing ground relative to those who participated in productive assets. And this is not due to intelligence or effort alone, but rather to positioning within the broader economic system, where capital that engages with growth mechanisms tends to be rewarded over time. There is also an identity component to the safe zone, because financial behavior is often tied to self-perception, and individuals who see themselves as cautious or risk-averse may unconsciously reinforce patterns that keep them within limited ranges of opportunity, while those who shift their identity toward being participants in systems of growth begin to approach money differently, not as something to simply protect, but as something to allocate, test, and evolve over time. Importantly, leaving the safe zone does not require extreme risk or sudden changes, but rather a gradual reorientation of decision-making, where small portions of capital are directed towards assets or systems that have the potential to grow, allowing exposure to compounding without compromising overall stability. And this measured approach creates a bridge between preservation and expansion, reducing the psychological resistance that often prevents movement. Over longer horizons, even modest differences in allocation can lead to significant divergence because compounding operates quietly but powerfully, and the earlier participation begins, the more time works in favor of growth, which means that the cost of remaining in the safe zone is not always visible in the present moment, but becomes clear when comparing outcomes across decades rather than months or years. At a systemic level, modern economies are structured in ways that naturally benefit those who engage with growth-oriented assets, because businesses expand, markets evolve, and value creation continues regardless of individual participation. And choosing not to engage does not pause these processes. It simply means that one remains on the outside of them, relying solely on earned income and static savings, which limits exposure to the mechanisms that drive long-term wealth accumulation. The safe zone, therefore, is not inherently negative. It serves an important role in providing stability and security, particularly in early stages or during uncertain periods. But remaining within it indefinitely transforms it from a protective space into a restrictive one, where the absence of risk also becomes the absence of growth, and recognizing this transition is often the first step towards changing it. What makes this dynamic particularly challenging is that the safe zone feels correct. It aligns with common advice about saving, avoiding risk, and maintaining control. Yet these principles, while useful in isolation, do not fully account for the broader economic environment in which money exists, and without integrating growth-oriented thinking, they can lead to outcomes that fall short of long-term financial resilience. A shift begins when stability is no longer seen as the final goal, but as a foundation upon which growth decisions can be layered, allowing for a more balanced approach where preservation and expansion coexist. And this shift is less about specific tactics and more about understanding each financial choice plays within a larger system that continuously evolves. In the end, the safe zone is defined not by safety itself, but by the limits it imposes when it becomes permanent, and recognizing those limits creates the possibility of moving beyond them in a controlled and intentional way, where money is no longer just maintained, but gradually positioned to participate in the systems that shape its value over time.